lately, you may have been noticing that the US dollar has been ascendant, and that has largely been due to the fact that the yield, well, that yields in general, but specifically on the 10-year yield, have been rising. There's a couple of reasons for this. And now, of course, since we're in a political season, all manner of explanations arise. When you look at the 10-year U.S. Treasury yield, you'll see here that we were sitting at around, 3.6, 3.7% in early September. And then we edged up a little bit up to about 3.75 or so. But then around the 27th of September, this number, this percentage began to go up. So the yield on the 10-year began to go up on around September 27th. Now, there's a couple of things to say about this because this is driving the dollar index up as well. And so for those who are, looking at the yields and the dollar and not really sure how it all works, in essence, the 10-year yield is probably the most important yield to pay attention to if you're an investor or a trader. It's the benchmark for borrowing costs pretty much globally. So as goes the 10-year, pretty much goes everything else. And so it's important to pay attention to that 10-year yield. Well, the question obviously arises is if the Federal Reserve just said that they are going to cut rates, then why in the world would interest rates go up in response to that? Now, there's a few answers to that question, and I want to address that first before we go further, because as we look at some of the charts, we may notice, especially when we look at the dollar, we'll see that it's moving higher. Now, there's a couple of things to say. The first thing to say is the fact that historically speaking, when the Federal Reserve begins to launch a new rate-cutting campaign, historically, that has led to a rise in the interest rate level, specifically the 10-year yield. Now, that may seem strange. You might say, well, now, if the Fed is coming out and announcing that they're going to lower interest rates, and then the yields rise, well, what could be going on? Why would that happen? Well, the first inclination, I think, in some people's minds might be to believe that investors don't believe the Fed. That is, the Fed is saying we're going to cut rates, but there could be some people who say, no, that's not, the Fed doesn't know what it's talking about, or it can't possibly cut rates because of this or that. Now, remember, we've been living in an environment now for 2 years where, at least 2 years, where I would say a lot of people, probably a majority, probably more than 50%, have, as far as, actual investors and traders, they have been expecting a recession. So there's been a lot of doom and gloom in the wake of 2022, which I really call recency bias. Quite frankly, it was due to the fact that we had this sell-off in 2022 that many people still remember, and it still hurts. And so the idea, and plus the inverted yield curve for such a long time, many are just scratching their heads and saying, where's the recession? Where's the recession? And now the Fed is cutting rates, and so for some people, it's just too much. They just can't believe their eyes. Well, in reality, the Fed is seeking to lower interest rates because, quite frankly, if they don't begin to lower interest rates, I think that we could be in for a tough time because, of course, interest rates have been elevated now for some time. Now, notice a couple of things here. First of all, the interest rate came down well before the Fed began to cut rates. And so what you have here is a standard sell the news event. Well, how do you get rates to go up if you sell the news? Well, you would be selling what? You'd be selling bonds. And so one of the ways that people locked in profits on the Fed announcement was to sell the news. That is, they had been, uh, buying bonds as they had been rising with falling interest rates, waiting for this Fed announcement. And when the Fed announced it, they sold the bonds, which caused the rates, which puts upward pressure on rates. If you're selling bonds, it's kind of like a seesaw. And so rates went back up. And this is absolutely positively very common after the first announcement of a rate cut, especially when it's sort of telegraphed. So this is a sell the news event. Okay, that's part one. So yields often jump after the first rate cut announcement due to the sell the news event. So you have a sell-off in bonds, and that's what we've seen. Now, this hasn't been a ferocious sell-off in bonds. In fact, you can look at this particular chart and see that the 10-year yield is still below a 200-day moving average. So it hasn't even got back up above that area. Secondly, we told you that it was around September 27th that we started seeing a real big uptick in this move. What happened on September 27th? Well, something else began to happen on September 27th, and that was that the Chinese yuan began to go down in value. And why in the world would the Chinese yuan go down in value? Well, it was because China is promising to douse its economy in debt. So they have been talking about unleashing fiscal and monetary stimulus. And they have to a certain extent, but they've promised more. Now, when you plan to solve your economic crisis by applying stimulus, monetary stimulus, fiscal stimulus, well, that's going to pressure what? That's going to pressure your currency. And so since September 27th, we have seen the Chinese yuan just going down on a regular basis every day in response to the fact that they're planning on taking on more debt. Now, if you know how currencies work, they work like seesaws, right? So if the yuan is going down, it must be going down in relationship to something else. What might it be going down against? Well, it's going down against the US dollar. So we can see here right around that same time, the dollar began to rise as China said, we're going to douse our economy in debt. So part of, not the entire part, but part of the reason why we're seeing the dollar rise in this environment with a pretty good vengeance here is because of the expectation that China is going to begin using debt to fix its economy. And that's going to pressure its currency, which we're already seeing. So we do have the yuan, which has been coming down. That's been pressuring the dollar up. We have this sell the news event in the wake of the Fed, which is pressuring the dollar up. And then you also have what? You have election jitters. You have market volatility that typically surrounds this time of year. In fact, believe it or not, there's a lot of attempts to manipulate the market around election season. I know that's difficult for most of you to believe. I say that tongue in cheek because most of you know that market manipulation can be a real thing. And so therefore, there are vested interests out there in people who would like to see the dollar rise right before the election. Believe it or not, there's actually people out there who would like to see the price of oil rise just before the election. And you'll tend to see that this often happens right before elections. So we have what? Less than 500 hours before the 2024 presidential election. And so therefore, you should also expect, in some ways, there to be some manipulation going on around that event. So we have a rising U.S. dollar. We have a sell the news event with bonds, and yields are going back up as they normally do after the first rate cut announcement. That tends to turn back around after a period of time and then begins to go down in line with the rate cuts. Secondly, we have China promising to douse its economy in debt, and it's falling. In response, the dollar is going up. And then thirdly, we have an election right around the corner, literally just a few weeks away. And in that kind of environment, you're going to have market jitters, market volatility. Oftentimes, when people are concerned, they will go to the dollar, kind of a flight to safety. And you also have market manipulation, where people would like to see that dollar. Some people would like to see that dollar go up right before the election, or they want to see oil go up right before the election, right? So you have all of these varied things that are happening. But the primary thing to look at is where that dollar is right now on this chart. Take a look at this chart, and you'll see that we are now closing in on what I think is going to be a very key test for the dollar, right at 104, right up to 104, 103.60 up to 104. Right now we're trading, as we speak, on the dollar about 103. So it's just about 103. So we're still about 1 point away from hitting the really hefty resistance, where I would expect the dollar would run into some resistance and then potentially start to come back down, right? So be careful about building your narrative around a 2-week move or a 1 week, a couple of weeks of price action. Be careful. The overall trend in the dollar is not up, and you can see it from this chart. It is not up. The overall trend of interest rates is not up. It is going down right now, right? So even though you have a near-term, kind of a rally going on here, it's really a rally in a bear market, okay? So this is a bear market rally for the dollar as it comes up to the 200-day. Now, if the dollar goes above 104 in any kind of sustained way, if it goes above 104 and it seems to like not be losing any kind of momentum, we're going to have a different discussion about that. But right now, it looks like it's heading to the 104 area, and that is going to be an area of major resistance. And that leads me to believe that we're going to see the dollar turn back around. Now, what's nice about that for gold and silver and Bitcoin investors is that when the dollar begins to turn back around and come back down after this near-term rally, well, that's going to provide a tailwind for gold and silver and Bitcoin prices and other asset prices. So in other words, you can kind of prepare yourself that once we hit that 104 area, if it doesn't, break, if we don't break out above it and just keep chucking higher, well, then we're likely going to start another leg down. And that another leg down will bring us back, I think, into this 101 to 100 level. And I suspect we will go lower than that even, because interest rates expected to come down. Now, I know, again, there are many voices out there who are saying the Fed doesn't know what it's doing. The Fed has lost the script. The Fed shouldn't have cut 50 basis points. There's all kinds of voices out there. But there is what I look at as price and volume. So over the years, I've learned to tune out the noise, to tune out the voices, because there's always a voice out there that is, going to be saying something contrarian that may sound, legit. But then you look at the chart and you say, no, that's not legit, right? And until the chart confirms that, you just have to ignore the voice. You have to ignore the noise. And that's difficult for new traders. New traders tend to think that somebody has a better answer than the chart. That's very common. Many new traders, in fact, will look for someone to give them all the answers because they think that's how it works. They think there's somebody out there with all the answers. And the longer that you're trading or investing, the more that you'll be humbled as you learn that, you don't have all the answers and you're learning, but you'll also realize that everybody else is in the same boat, no matter how much they know. Nobody knows what's going to happen tomorrow. And yet, the voices that are the most compelling are the ones who act as if they do know what's going to happen. And those are often the voices that attract the newer traders, because a newer trader wants certainty. They want certainty. They want someone to tell them this is what's going to happen. And when they find somebody who will do that, they will often, latch onto them and listen to them, only to find out later that that person really was just making it up as they went because they didn't know. Because nobody knows what's going to happen tomorrow. I don't even know what the weather is going to be next week. Neither do the meteorologists. They have a good guess, right? But I mean, how are we supposed to know what the market's going to do next week if we don't even know what the weather is going to do next week, right? And so somebody will obviously come along and tell you that he knows all the answers, or he knows what's going on, and you know, you need to listen to him. But the truth is that all we really can do is just follow the money. All we can do is just follow the chart. We can follow the price action. That's it. That's all we can do. And when I read it and when I look at this, I see the dollar is having a near-term counter rally, and it's looming in on 104 resistance. And why is this news? This is news because when it begins to break, which I think could happen around 104, time will tell, that's going to serve as a fresh tailwind for gold, for silver, for gold miners, for silver miners, for Bitcoin miners, for Bitcoin, right? All of these assets that many of you are following, that 104 area is what I'd be watching on the chart to see. I'd be turning off all the noise from all the talking heads who are, you know, obsessed with the election and trying to influence you in one way, shape, or form. Turn those, you know, numbskulls off, and then just look at the chart. Look at the price, look at the volume, pay attention to what's happening, and pay less attention to the gurus who are telling you exactly what's going to happen, and you know, and all of this. Okay, somebody probably needed to hear that today. That's why I'm talking about it. Somebody out there might be new today and says, I needed to hear that. And so anyway, the dollar 104, that's the area we're watching. And you can see in this chart in particular, this chart really shows that action playing out, how you have the back and forth. Look at this, just like a ping pong ball. I mean, just back and forth between the 106, back down to the 100, back down to the 106, you know, up to the 106, back down to the 100, and just kind of back and forth. You can see this really tight grind. And we're just kind of right in here, right? There's no uptrend in the dollar. It's literally going nowhere. It's going sideways right now, right? So it'd have to cross above 104 to get our attention. And then at that point, it would have to get above the 106 to 108 resistance zone, which it barely did whenever rates were at 9%, or when inflation was at 9%, you know. So we're not expecting the dollar to go back up that much, or rates for that matter. If the rates begin to go up, we'll follow that money, we'll follow that chart, that pattern, and we'll pay attention to it. But right now, we don't have that. So the dollar showing some near-term strength, but we think it's just about near its end based upon the chart and nothing else. Let's see here. Also, looking at the S&P 500 pushing to a new record high, as we had talked about. So the S&P really enjoying this rally. The last long-term uptrend we issued was back in June of 2023. Since that time, the S&P has rallied from around 4,300 all the way up to 5,800. What an incredible rally this has been for the S&P 500, rising about more than 63% or so from its October 2022 lows. That's really crazy when you think about the S&P 500 as big as it is. If you look at the breadth of the markets right now, it's about 80% or so of the stocks in the S&P 500 trading above their 200-day moving average. And also, that 80 level is kind of right there at the line where we start to say, it's starting to look like it might be time to take profits, right? And what we mean by that, and the last time we did that was, back in here, but the reason we say that is that when you get up in that 85% or so of stocks in the S&P above the 200-day moving average, you're just normally at a place where there's just not much more room, It can stay there for a little bit, but at that same time, if you're taking any kind of profits off the table on, positions that have really appreciated, well, that's a fine place to do it, right? It's definitely better to do it there than it is to take profits when you're way down here. When there's this is where most people take profits, right? But that's where most people sell, let alone profits. Forget profits. A lot of people begin to sell, when you're down here. When you're way down here, when there's everybody's thrown in the towel and you're like, okay, I guess I'll sell, this is usually where people buy, right? Whenever they start, it has to keep going higher. Well, it can, but at some point you have diminishing returns, And so we're up at an area here where we're close to it. And I think I had told you I trimmed a little bit in NVIDIA. I trimmed about 4% out of my long-term position. That's my largest position, is NVIDIA. I trimmed that position last week to the tune of about 4%. Took some money off the table. If this pushes up a little higher, gets back up in that zone, I'll probably take just a little bit more off the table on that position and a few other positions too, just to raise cash, because inevitably we'll come back down a little bit and we'll have opportunities, so you want to have a little dry powder on the side for those opportunities. Russell 2000, right here at the 225 level. This is what we've been talking about now for some time. We're finally seeing it. Now it's knocking at the door. IWM trading right now at 224.76. It's knocking on the door here. Really wants to break out. We're looking for a close above 225 on IWM, and we think that could spark a really good rally in the Russell 2000, which has already had a nice recovery from its 2022, 2023 lows. But we think there's more upside in small caps. If you look at their valuations compared to large caps, a lot of them have been left for dead. And as money flows back into the market from the sidelines, which there's a ton of money on the sidelines still, then you could also see these go up. Speaking of money on the sidelines, let me just say this real quick, is that when the election happens, remember there's a lot of people who invest based upon the election, which I don't think that they should. I don't think people should trade or invest based upon their politics, but nonetheless, who cares what I think, because people will do it anyway. And so many people will invest based upon their politics. So if their favorite candidate wins, well, they'll go all in. And if their other candidate wins, well, they get real nervous Nelly, and they don't know what to do. Well, in all cases, that usually doesn't work out for people. It's better just to have a plan and stick to it, and just realize that the president's going to change, right? That's a better way to handle it. Is that, okay, this is a rotating presidency, so I can't just be jumping in and out, in and out, in and out every time this thing changes. I'm just going to go ahead and invest because I want to invest, And so that way you're not jumping in and out based upon, some political ad or whatever. So the point is that IWM, I think, could really have a nice run. And when the election is over, hopefully we'll have clarity and certainty. I fully expect that we will. I suspect some people will think that we don't, and that could cause problems. But nonetheless, when we do have that election and the certainty is there, that could cause some of that money that's on the sidelines to come in, because there's a lot of money on the sidelines right now. As I told you, like $6-7 trillion in CDs and money markets and whatnot, earning a diminishing return now because it was higher. Now it's coming down. So they are going to be looking for stocks to go into, or bonds or whatever. And as they come in, that's going to drive yields down on the bonds, and it'll drive stock prices up when they come into stocks. And when they do, a lot of them are kind of waiting, and we're just, we're just a few weeks away. So once they know who's going to be president, some people are going to step back in. Plus, November is when the sell in May and go away crowd comes back. Remember, at the beginning of November, they come in. So most of them are going to wait to see the election results, and then they're going to come back into the market. That could also give us a really nice big, rally into the end of the year. So that's what we could see. And I think, small caps could benefit from that rally, because when people are looking for, underperforming or undervalued stocks that have good earnings outlook, you're going to see a lot of small caps there. Now, I'm not a huge small caps fan. I don't really invest in them hardly at all. I'll occasionally, but I just think overall that small caps are beaten down relative to other markets. And so I think they have a catch-up trade here. And that's why I'm watching for them to break out above 225 on IWM. Also, CALF just recently kind of getting above its 200-day moving average again in a meaningful way. and it's trying to break out as well. That's another way to trade or invest in small caps. I don't want to spend too much time on China because we are running out of time. But China, we're seeing it. We saw a nice rally here and a pullback. FXI is one way to follow this trade. We do think that if Beijing can, do what it said, it pledged to quote unquote significantly increase its debt to revive its economy, but the specific details are missing, so we don't really know what that means. And that's why you're seeing the market kind of not be sure what to do. Beijing is promising some bazooka policy, but they're not really being clear on what that means. And for investors, uncertainty again is the killer. And so we are seeing Chinese stocks pull back here. In my opinion, just my opinion, I think this is an opportunity because I do think China is serious, and I do think that they're going to address the property market, the local government debt, a lot of the low consumer confidence among the Chinese people. They know they have to do something. And so they may misfire a couple of times as they try to get it figured out, but I don't think China is going away anytime soon. Its equity market is very difficult and notoriously difficult due to various things, especially some of the infighting that is occurring between our leaders and their leaders. But nonetheless, FXI looking interesting here. Also, gold pushing up to where it was before. We're still sitting below the recent all-time high, which was just above 2,700, but we're sitting just right below it. Volume's still pretty good. On that monthly chart, we're up at around 80. So we are historically, where we would say this is where you normally get to on the gold rally before you begin to exhaust a little bit and consolidate. But we could have just a little bit more room here. So we could have a nice year-end rally here in gold before it starts to top out and flatten out for a bit, maybe curl down a little bit, consolidate. And then we suspect it'll probably continue even higher after that. But everything needs a chance to get a break. And we've been running breathlessly from that, that low in 2022. It's really had a nice run. GDX sitting, as you look here, it's GDX, it remains in this bullish channel. We just continue to watch that channel. You can see you've got really nice support there just below 38 on this bullish channel. So GDX looking nice. GDXJ recently getting 50-day moving average bounce on high volume. It's pushing higher. We have a 42.50 support level that still hasn't been violated there. Newmont, one of our top ranked gold miners, and one that Steve owns. As you can see here, the rally, the pullback to the 50, and like a champ, it does exactly what it's supposed to do in that kind of environment. It bounces right there off of the 50. We like those 50-day moving average bounces. You had one there. You had the breakout here. Here, came back, tested, come back to the 50 bounce, 50 bounce. Usually get 2 or 3 of those after a nice 200-day moving average breakout. Silver really respecting its 30-day moving average. The 30 SMA, you can see here in this zoom thumbnail where here's the 30-day, and you can see that it's almost as if silver knows that it's there. You can even see how it just really respects that area, just sitting right there at the 30, as if it's real. The 30, of course, is not real. It's just we just impose it on the chart. But you can see how silver really respects this area. We'll be watching for it to hold this level here, which is currently at about 30.82. I would be watching that area. The 30 is really important in the near term. Of course, the 200-day much more important. That 26.50 support level also very key. SIL, the Global X Silver Miners ETF, is still sitting well above the $30 support range that we've talked about now for a little bit. Definitely got support at the 50-day rising. SILJ looks very similar, 1050 support. And you've got this nice rising 50-day moving average. Volume is nice and, pretty nice and high. Quite frankly, since the beginning of September, we've seen some really good inflows.